There exists a combination of tax implications that could cost a retired homeowner $75,000 whenever they dispose of a residence they've held for decades. Not because they committed fraud, not because they concealed anything, because of one harmless family choice most people have never learned about. I know a lady in Ohio who discovered this the difficult way. She held her residence for 34 years. She disposed of it last year, anticipating to owe nothing in taxes. She'd resided there her entire grown life, brought up her children there, paid it off years prior, a straightforward sale, a new beginning. She owed $23,400, and the choice that triggered it she made at her dining table on a Tuesday afternoon, believing she was acting wisely, believing she was safeguarding her family. It required her fewer than 10 minutes. If you are past 60 and you hold a residence, April 15th is the cutoff that decides whether you can resolve this quietly or handle it the difficult way. And I mean that precisely as seriously as it sounds. I'm going to explain to you precisely what she did and why it's relevant for you right now. But before I dive into it, a brief note. Everything I discuss today is grounded in current IRS regulations and federal tax legislation, including the One Big Beautiful Bill Act enacted into law July 4, 2025. Nothing in this presentation is a replacement for guidance from a licensed tax specialist. Use it as a foundation, not a definitive answer. Here is what this presentation addresses. 4 pitfalls. 4 entirely routine homeowner choices that are quietly generating IRS complications for seniors right now. Then 3 items that could genuinely return money to your wallet on your 2025 filing that most individuals over 60 have never learned about. Then a 7-step action guide, including a free resource on the IRS's own website that reveals to you precisely what data they already possess on your property. Most individuals only discover the pitfalls. Very few discover the funds they are leaving unclaimed. By the conclusion of this presentation, you will understand both. Do not exit early. The 4 pitfalls form one word: home. H stands for home equity errors. O stands for ownership and deed modifications. M stands for move-out scheduling before a sale. E stands for extra revenue from the property. Before we continue, if this proves useful today, please press the like button and forward this to anybody in your circle who is past 60 and holds a residence. That one forward could rescue someone thousands of dollars. The individuals who require this most are typically the last ones to discover it. Now, let me complete her story. Her name is Margaret. She is a fictional combination derived from real circumstances tax specialists encounter regularly. Every individual I reference in this presentation is identical. Real outcomes, composite individuals. Margaret's husband died away a few years back. Her daughter Sarah stepped in after that. Shopping, maintenance, medical visits, everything. One afternoon, Margaret's neighbor suggested that putting Sarah on the deed would simplify things afterward. Skip probate, retain the residence in the family. It seemed like good judgment. So Margaret proceeded. County Recorder's Office. Basic form. No lawyer, no tax specialist, no cause to reconsider. Here's what nobody informed Margaret. When you convey partial ownership of your residence to another individual, even your own daughter, the IRS can classify that as a taxable gift. Depending on the amount conveyed, that may activate a reporting obligation on Form 709. And when the residence is ultimately sold, the individual you placed on the deed may not be eligible for the same tax exclusion you receive because they never resided there as their main residence. Margaret learned 2 years afterward when her tax preparer examined her filing and uttered 4 words she was not prepared to receive. We need to discuss. Every dollar of that obligation was avoidable. The IRS does not consider why you did something. It only examines what you did and whether it was recorded properly. Good motives do not appear anywhere on a tax filing. So, let's explore the home equity errors. Remain with me because this is where most people's attention drifts away. And that drifting away is precisely what costs them funds. Most homeowners assume that if funds originated from their residence, it must be linked to the residence for tax considerations. That belief is incorrect. Complete stop. A senior borrows $40,000 or $50,000 against their residence through a HELOC. They apply it to assist a grandchild with tuition, handle a medical crisis, or eliminate debt. And because it originated from the residence, they presume the interest is deductible. It is not unless the funds were applied to purchase, construct, or meaningfully upgrade the residence securing the loan. That is the guideline under the Tax Cuts and Jobs Act of 2017. If the funds went elsewhere, that interest is personal interest, not deductible. And declaring it incorrectly generates a discrepancy that the IRS's computerized systems are progressively effective at identifying. Reflect right now. Did you obtain a home equity loan or establish a HELOC in the past 3 years? Where did those funds genuinely go? Into the residence or elsewhere? If it went elsewhere, you require a discussion with a CPA or enrolled agent before April 15th, because if that interest was managed incorrectly, there are measures accessible right now that become significantly harder after the cutoff passes. And the O pitfall is the one that provokes the most disagreements when I describe it because individuals hear it and instantly declare that cannot be accurate. That is merely a family matter. I encounter that every single instance, and every instance I respond the same thing back. That is precisely why it is so hazardous. A senior places an adult child on the deed for estate organization, probate prevention, or simply because that child has been assisting and it seems appropriate. What seems like a family matter is likewise a tax matter, and those two considerations do not always desire the same result. Consider the past 5 years right now. Has anyone's name been placed on your property? A child, a grandchild, anyone? If yes, and no gift tax filing was submitted that year, continue listening because this following section is specifically for you. When you place someone on your deed without them providing fair market value, the IRS can designate that as a taxable gift. When the amount conveyed surpasses the annual exclusion threshold, a Form 709 gift tax filing is generally needed depending on the arrangement of the conveyance and your individual circumstances. If that was never submitted, that is a documentation void sitting quietly in your records. And when you ultimately sell, the individual you placed on the deed may not be eligible for the primary residence exclusion. The provision that permits most homeowners exclude up to $250,000 in capital appreciation or $500,000 for married couples because they never resided there. Their portion of the appreciation may be completely taxable. A transaction that should have been tax-exempt becomes partially taxable over a deed modification that required 10 minutes. I have spoken to seniors who discovered this at the settlement table, not ahead of the transaction, not during the marketing, at the settlement table. Documents already before them. That is when they received the information. There is additionally the basis concern. If you conveyed the residence entirely as a gift rather than passing it as an inheritance, the recipient obtains your original acquisition price as their cost basis, not current value. If you spent $80,000 and the residence is valued at $380,000 today, they could face capital gains tax on $300,000 when they sell. Had they inherited it instead, the basis would adjust to present market value and that appreciation would largely vanish for tax considerations. One approach costs the family nothing. The alternative costs them tens of thousands. The sole distinction is the scheduling of the conveyance. Now, that particular reason, April 15th, carries more significance than individuals appreciate. The IRS operates an automated system designated the Automated Underreporter Program. It cross-checks your tax filing against third-party information. Mortgage providers, rental platforms distributing 1099-K documents, and property-connected records. The distance between what you declared and what the IRS can observe has been contracting for years. Tax specialists are encountering more automated notifications and more matching inconsistencies than at any point in recent experience. After April 15th, if something hasn't been resolved, interest begins accumulating automatically, penalties compound. And the first-time penalty reduction program, a genuine documented IRS policy that permits taxpayers with a pristine compliance record to petition significant decrease or removal of certain penalties, becomes harder to utilize once assessments are completed. The sooner you respond, the more alternatives you possess. Now, the move-out scheduling. This is the one that affects seniors most severely, and it is the most misinterpreted provision in residential tax legislation. Under IRS Section 1-21, to exclude up to $250,000 in capital appreciation from your residence sale, $500,000 if you're married filing jointly, you must have resided in the residence as your main dwelling for at least 2 of the 5 years directly preceding the transaction. That is the 2 out of 5 provision. Here is where it silently devastates people. Let me demonstrate to you precisely how this occurs. And as I review this scenario, I want you to envision your own residence, your own location, and consider where you have been residing for the past 3 to 5 years. You relocate with your grown children because of a health concern, or into a more modest place while your residence remains on the market, or you begin leasing it out while you delay selling. All of these are comprehensible choices. All of them influence your residency determination. Say you relocated with your daughter in January 2021. You retained the residence, attempted to sell, couldn't obtain the price, leased it for a year, and ultimately sold in March 2026. You departed January 2021. Transaction closed March 2026. That is beyond 5 years since you last resided there. Under the 2 out of 5 provision, you may not be eligible for the exclusion whatsoever because both qualifying years fall outside the 5-year look-back period. If the residence appreciated $200,000, you could face capital gains tax on the complete sum. For most homeowners in this earnings bracket, that is approximately $30,000. Not because you committed anything improper, because retirement conditions and a tax scheduling provision collided in a manner nobody cautioned you about. There are partial exclusion clauses under Section 121C for health-connected relocations. They are legitimate, but they demand documentation and do not activate automatically. And here is something I want you to retain because Dorothy's account in a few minutes demonstrates precisely what occurs when this pitfall merges with the following one. If you have departed from a residence you still hold and intend to sell, tally the months this week. The opportunity to resolve this exists right now, and now the extra revenue from the property. This is the one individuals dismiss initially because the sums seem minor. That dismissal is precisely what renders it costly. A senior leases out an extra room, perhaps through a short-term rental service, perhaps simply to a university student, perhaps a relative contributes something modest to occupy the basement unit. It handles the utilities. It seems like a sensible arrangement. But the instant your residence produces rental revenue, any sum, any arrangement, the IRS categorizes that portion differently. 3 aspects shift. First, that revenue must be declared on Schedule E. Casual arrangements are not excluded. No official lease does not indicate nothing to declare. Second, a share of your residence costs become potentially deductible against that rental revenue, but without records, you either encounter audit vulnerability or you overpay. Third, if you subsequently sell the residence, the rental share may not be eligible for the primary residence exclusion. The appreciation gets distributed between residential and rental shares. The rental share can be taxed as a capital gain. And depreciation recovery under Section 1250 taxed at up to 25% can pertain to the rental share even if you never claimed depreciation in the first instance. That extra room you leased for $600 a month for 2 years can influence the tax handling of your complete residence transaction. Not merely that room, the entire deal. Now, Dorothy. Dorothy is 68, Tennessee, resided in her residence for 27 years. In 2022, a health episode compelled her to relocate with her son, Michael. Temporary. She assured herself to manage costs while she delayed selling. She leased the residence to a young couple. How $100 a month? She didn't declare it the initial year because her accountant had recently retired and the program she utilized didn't pose the proper questions. The subsequent year, Michael placed his name on the deed just in case Dorothy's condition deteriorated. No gift tax filing submitted. Early 2025, Dorothy sells 27 years of possession. She entered that settlement anticipating a clean, essentially tax-exempt transaction. The IRS concluded she had departed more than 2 years prior to the transaction. The rental duration had altered part of the residence's designation. The deed modification generated a gift reporting void. The undeclared rental revenue was a distinct liability beneath all of that. Dorothy owed $23,400 across 3 distinct matters, none of which she recognized existed when she made the choices that triggered them. She wasn't negligent. She wasn't concealing anything. She was a 68-year-old woman handling a health emergency, a housing change, and a family circumstance simultaneously, without anybody informing her what she needed to understand. Dorothy did not disappoint the system. The system disappointed Dorothy, but the system does not correct itself based on that reality. That is the entire purpose this presentation exists. I want you to reflect on that for just a moment because what follows next is authentically different from everything we have addressed so far. And most individuals viewing this are going to wish they had understood it earlier. Now, the opposite side of this, because everything until now has been about difficulties, the following few minutes are about funds you may be leaving unclaimed right now. Actual funds confirmed by the IRS, accessible on your 2025 filing. The first is completely new, and most preparers are not highlighting it automatically. It is termed the Senior Bonus Deduction, and it is part of the One Big Beautiful Bill Act, enacted July 4, 2025. If you are 65 or beyond, you can now declare an additional $6,000 deduction on top of whatever you already deduct. Whether you itemize or select the standard deduction, it accumulates on top of both. Married with both partners 65 or beyond, that is $12,000 combined. Accessible for tax years 2025 through 2028. Reduces beginning at $75,000 modified adjusted gross income for individual filers and $150,000 for combined filers. For numerous seniors in the range where 50 to 85% of Social Security is taxable, this deduction draws taxable earnings down enough to decrease that vulnerability. It will not remove Social Security taxation completely, but it can substantially lessen it. For numerous seniors, that is $1,000 to $2,500 in actual savings. This clause was embedded in an 1,100-page bill. Some tax programs have not been refreshed. Some preparers have not kept current. Ask your preparer specifically, did you implement the senior bonus deduction from the One Big Beautiful Bill? If they appear puzzled, locate someone who does not. The second is the SALT deduction expansion. From 2017 through 2024, the state and local tax deduction was restricted at $10,000. For homeowners in New Jersey, New York, California, Connecticut, and Illinois, where property taxes alone frequently surpass $10,000, that restriction was burdensome. You remitted the taxes. You received no deduction for the surplus. As of 2025, that restriction is now $40,000. For 2026, it is $4,400, rising 1% per year through 2029. The reduction begins at $500,000 in modified adjusted gross income, well beyond where most retired homeowners fall. Here is the difficulty. When the restriction fell to $10,000 in 2017, millions of homeowners transitioned to the standard deduction and never reconsidered. 8 years on autopilot, the restriction has multiplied fourfold. Their practices have not adjusted. If your property taxes plus state income taxes surpass $10,000, recalculate the figures again. Combine your total SALT with your mortgage interest and charitable donations. If that combined amount surpasses the standard deduction for your filing category, you should be itemizing. If you already submitted using the standard deduction when itemizing would have benefited you more, you can modify within 3 years. Do not abandon that money sitting there. The third is the energy credit. If you added solar panels, a heat pump, battery storage, or other qualifying energy upgrades in 2025, the 30% federal residential clean energy credit is still available on your filing for that installation. The One Big Beautiful Bill removed this credit effective December 31, 2025. Systems added and functioning by that date still are eligible. Systems added January 1, 2026 or afterward do not. The IRS has verified the deadline is determined by when installation is finished and the system is activated in service, not when you executed the contract or submitted the deposit. If you have a 2025 installation and have not yet submitted, ensure that 30% credit is declared. On a $30,000 system, that is $9,000 you do not wish to leave uncollected for upcoming upgrades in 2026 or afterward. That federal credit is eliminated. Some states still maintain their own programs, but the 30% federal credit that millions depended on is no longer obtainable for new installations. Now, this final one is different. It is not regarding your tax filing at all. It is not regarding something you did incorrectly. It is regarding money departing your bank account every single year right now that you may be capable of halting today with a 20-minute phone call. And there is one additional thing most seniors have never been informed about. This one has nothing to do with the IRS. It is a state and local property tax advantage, and it differs by where you reside. But for numerous individuals viewing this, it is valued more over time than anything else in this presentation. Almost every state in America provides a property tax homestead exemption for seniors. These are not minor reductions. In Texas, the over 65 homestead exemption alone can decrease your residence's taxable worth by $60,000 or more on top of the standard homestead exemption, preserving some homeowners $4,000 to $6,000 every single year. Florida locks your property tax valuation at the amount it was when you initially qualified, meaning even if your community doubles in worth, your property taxes do not increase. Georgia provides complete exemptions from school taxes for eligible seniors. New York, Pennsylvania, Ohio, Illinois. Almost every state maintains a variation of this. Here is why this should cause you genuine frustration. These exemptions are not automatic. Nobody delivers you a notification when you reach 65 indicating your taxes just decreased. You have to petition. You have to visit your county assessor's office or appraisal district, complete a form, provide proof of age and residency. If you have been 65 or beyond for years and never petitioned, you have been overpaying. Some states permit retroactive petitions going back 1 or 2 years, meaning you could receive a refund on taxes already remitted. Contact your county appraisal district this week. Inquire what senior property tax exemptions are offered. Carry your ID and your deed or a recent tax document. It requires about 20 minutes. And for numerous individuals viewing this presentation right now, that contact will preserve more money over the coming 10 years than anything else addressed here today. Now, before the guide, 60 seconds on something that has nothing to do with taxes. It has to do with shielding yourself from individuals who will exploit everything you just discovered against you. Every tax period, fraudsters target senior homeowners aggressively. Telephone calls, messages, individuals impersonating IRS representatives claiming you owe funds right now and will be detained if you do not remit by wire transfer or gift card. The actual IRS does not telephone you requiring immediate payment. The actual IRS does not receive gift cards or wire transfers. The actual IRS does not threaten detention over the telephone. The actual IRS corresponds through official postal delivery with a notice number in the upper right corner of every correspondence. If anyone reaches you claiming to be the IRS and generates urgency around immediate payment, disconnect. Remove it. Report it to the IRS phishing notification line at irs.gov. The concerns in this presentation are genuine. The individuals attempting to manipulate your anxiety about those concerns are likewise genuine. Recognize the distinction. Now, the action guide. 7 measures this week. Measure 1. Retrieve your last 3 years of tax filings. Examine Schedule A for mortgage interest. Search for Schedule E. Rental revenue resides there. Search for any 1099 linked to the property. Anything absent or unexpected, document it. Measure 2. Locate your deed. County Recorder's Office can supply a copy electronically for a nominal charge. Verify every name recorded. If a name was placed in the past 5 years and no Form 709 was submitted, that requires professional evaluation before April 15th. Measure 3. Chart your residency schedule. If you have departed from a residence you still hold, determine how many months since you last resided there as your main dwelling. If that figure is at or beyond 24 months and you have not sold, obtain professional evaluation before the transaction closes. Measure 4. Review your IRS account transcript at irs.gov. Establish a free account. 15 minutes, you will observe every notification on record for your account and every piece of third-party information the IRS has correlated to your Social Security number, including 1099-K information from rental services. If the IRS possesses data about your property that does not correspond with your filing, you will observe it there. Awareness is the only thing that provides you alternatives. Measure 5. Monitor your home equity records. Locate documents for any HELOC or home equity loan. Document precisely what those funds were applied for. If they went into the residence, you likely possess a clean paper trail. If they went elsewhere, your filing may require evaluation. Measure 6. Catalog every rental arrangement the property has experienced. Any sum, any arrangement, dates, and figures. A tax specialist can inform you what was managed correctly and what requires attention. Measure 7. Reach out to a CPA or enrolled agent this week if you possess any doubt after measures 1 through 6. The National Association of Enrolled Agents maintains a free listing at naea.org. Search by area and expertise. When you telephone, inquire specifically whether they possess experience with IRS penalty reduction for real estate concerns. That one inquiry reveals to you immediately if they are the appropriate individual. Dorothy completed none of these 7 measures. Not because she was negligent, because nobody provided her this guide before she required it. You possess it right now. Apply it. The expense of a professional evaluation is almost always smaller than the expense of the difficulty it was intended to prevent. Let's consolidate it all together one final time. The 4 home pitfalls. H. Home equity. Funds from your residence are not automatically categorized under IRS provisions. O. Ownership modifications. Placing someone on your deed is a tax occurrence, whether you planned it to be or not. Move-out scheduling. The 2 out of 5 provision does not suspend for retirement or health changes. E. Extra revenue. Rental revenue from your residence alters its tax designation, and that alteration accompanies the property all the way to the transaction. The 4 items functioning in your benefit right now. The $6,000 senior bonus deduction accessible on your 2025 filing. The SALT cap at $40,000 if you reside in a high-tax state and remain on standard deduction autopilot. Recalculate the figures again. The 30% energy credit for 2025 installations that have not yet been submitted, and the senior property tax homestead exemption sitting unrequested at your county appraisal district that could preserve you thousands every year. If even one of the 4 pitfalls seems recognizable, do not categorize this away as something to contemplate about afterward. That is precisely how Margaret ended up receiving those 4 words. That is precisely how Dorothy ended up owing $23,400 on a transaction she anticipated to be straightforward. Begin with Measure 1 tonight. The cutoff is April 15th. By then, what could have been a quiet resolution becomes a scramble, and scrambles are costly. If this presentation assisted you, press the like button right now. Subscribe if you are not already present. Forward it to anybody past 60 who holds a residence. And post a comment below. Which one of these did you not understand about before viewing? That inquiry authentically assists me determine what to address next, and your response might be the subject of the following presentation. In the following presentation, I'm going to review Form 709, the gift tax filing that most seniors never submitted when they altered their deed, and demonstrate to you precisely how to resolve that void before it becomes an official IRS notification. If Margaret's circumstances seemed recognizable when I shared her account at the start of this presentation, that following presentation is specifically for you. It is already on your display. View it now, because this is precisely the type of subject where delaying costs you more than responding.